Good morning, good afternoon, good evening, and welcome to Martyn Lucas Investor. We're just 29 minutes away from NextEra Energy earnings. And of course, we are watching the markets closely because of Tesla last night. A big drop in Tesla. So will we see an entry point to pick up some more S&P? I have $100,000 on standby to buy, looking for dips. So let's see what happens today. Our next stock that we're interested in is NextEra Energy. Oh, hang on a minute. All of a sudden, the S&P has just gone up. We've just had a little bit of a bounce in the last few seconds. Let's have a quick look. There we go. As you can see, we're just moving up. Let me just bring it on the screen here for you a bit better. There you go. You can see we just had a bit of a pop there. If we look at Virgin Galactic has now broken down below $2. As we reported on the show, the retail investor does not like Virgin Galactic's approach to not focusing on the celebrity. They voted with their money, they've sold out their positions, and many of our retail investors have dumped the stock 2 days before, 1 day before a flight. This is incredible. Really, bearish on Virgin Galactic, sadly. We see Palantir is up, gold is down, the S&P is doing well, going up nicely now. This morning, Apple is moving up, it's down but moving up. I beg your pardon. Amazon is down, Apple is moving up, NextEra Energy is up, just pulling back again. Enphase Energy is going up, Coca-Cola is going up, J&J is flat at the moment, Kenvue, Chevron, Tesla is still going down, 189 now. So with the S&P moving up and Tesla going down, playing 1.7% of the S&P, maybe now is the time to buy more S&P because everything else is going up. Google, Microsoft, Walmart, Tilray, Robinhood, IonQ, Rocket Lab, Plug Power is down, but pushing up. Rumble down, rubbish, down 3.7. Funware down. Faraday it's up slightly. Rio Tinto up. Cider Space is flat at the moment. Lilium is up 0.64. iCAD, that's one of our stocks we've been covering. We reviewed it. Ever since we reviewed it, it's been going up. We bought it here. The Lucasades own that one. Very nice indeed. Bitcoin is up 0.16. Polygon is up 0.22. XRP is down 0.29. All right, let's go back to Enphase Energy and let's go over to our earnings screen. And let's get ready for it. In 26 minutes time, we'll be covering it. Welcome to everybody this morning. It's a big morning. The S&P is up again this morning. My portfolio is looking good, looking very good. If I look at it this morning, I'm up 0.3. We are now at 66,229. So the markets are moving upwards this morning, even though Tesla is down. But anyway, it's all about NextEra Energy in 25 minutes time. That's what we're covering here this morning. Then we've got 2 reviews to cover during the main session. Holland, the Netherlands, welcome to you. Kai Niazi, good afternoon. Welcome to you. Lovely to have you here. We've got several members, actually, from the Netherlands. I think so. Hang on. Let me just double check that. Am I right in saying that? Hang on. Netherlands. Have we? Yes, we do. Yes, we do. We have members in 56 countries. There we go, around the world. 98% of our live viewers are members, more than any channel on YouTube TV. We're very proud of that. Please welcome a guest in today from the Netherlands. Shall I speak Dutch to him? I'll give it my best shot. You ready? Okay, let's speak some Dutch this morning as we keep our eye on NextEra Energy. Let me say hello to our guest today from the Netherlands. So let me set it up, see if I can do it. So this will be Dutch. And here we go. Good morning. Welcome to our show. Welcome to all guests and friends in the Netherlands and Holland today. Thank you very much for being here. We aim to be the most honest, real, live YouTube TV channel in the world. We go live up to 10 hours a day. There is this channel and my music channel. I'm the World Piano Man. I will give you the link in the chat. I'm here to help and support in any way I can. Help with answering your questions. And everyone here has a voice. Welcome to the show. Right, let me put your name in there. And let me put his name in. K-N-I-A-Z-I. Here we go. Here it comes in Dutch. Are you ready? This is for you.
Goedemorgen Kaniazi, welkom bij onze show. Welkom aan alle gasten en vrienden in Nederland en Nederland vandaag. Hartelijk dank voor uw aanwezigheid. We streven ernaar om het meest eerlijke, echte live YouTube TV-kanaal ter wereld te zijn. We gaan tot 10 uur per dag live. Dag is er dit kanaal en mijn muziekkanaal. Ik ben de wereldpianoman. Ik zal je de link in de chat geven. Ik ben hier om je op welke manier dan ook te helpen en te ondersteunen. Ik kan je helpen met het beantwoorden van je vragen en iedereen hier heeft een stem. Welkom naar de show.
There you go. Welcome to you. All right, we're looking at NextEra Energy earnings today. Now let me see why the markets are moving this morning. Durable goods, GDP growth. Here we go. Let me have a look. 7:30 this morning, just in. We've got some figures just in why the S&P is moving up this morning. Let's have a quick look. All right, here we go. Let me bring it on the screen. This has just come in. Here we go. This is partly the story. The US economy expanded an annualized 3.3 in the last 3 months, much better than market forecasts of 2% rise, following a 4.9% rate in Q3. According to the advanced estimate, it reflected increase in consumer spending, exports, state and local government spending, non-residential fixed investment, federal government spending, private inventory investment, and residential fixed investment. All imports also went up, considering for 2023. The US economy grew 2.5% compared to 1.9% in 2022, and Fed's estimates of 2.6%. The figures showed the Fed's tightening campaign took a hit on the economy, but the toll was less severe than initially anticipated as a tight labor market continued to support consumer spending. There we go. The markets like it. The S&P is moving upward today. There we go. So this is good news today. Let's see what else I've got for you. Durable goods ordered. New orders. Let me zoom in, make it clearer for you. New orders of manufactured durable goods in the United States were virtually unchanged in December 2023 after a 5% rise seen in November and missing market expectations of a 1.1% increase. Excluding transportation, new orders increased 0.6%, excluding defense. Okay, well, as we can see, the markets like this morning. We have gone up. The S&P is up 0.39. We're back to NextEra Energy. That's what we're covering this morning. It's a big day today for us. We've got NextEra Energy earnings coming up in a moment, in 20 minutes' time. And we've also got 2 reviews today. We'll be doing more reviews today. All right, let me read the comments that I've missed. Henrik from Denmark. Good morning to you, Henrik. How are you this morning? Lovely to have you here. Hi all, says Raman. I love the price of Virgin Galactic. Buy when others are fearful, sell when others are greedy. Well, that's okay as long as it's undervalued. And that's what we like to buy. We do our research, we analyze stocks, we look at the numbers, and we find, like NextEra Energy, we find the value. We don't just buy whatever looks cool or whatever. We are looking for stocks that are undervalued. I love a can of Coke, but I would not pay $500 for a can of Coke. That's equivalent to buying Tesla at the moment. I love what Tesla are doing. However, got to buy it at the right price. As an investor, I'm looking at value. Always looking at value. All right. Let's go back to NextEra Energy. We'll keep our eye on that for a moment. Henry, good morning, says Bill. Gula and Philippe, hello everyone. Good morning to you, Octavio. Good morning. Good morning. Bill is saying hello to everybody. Greetings from Holland. Plug does not look good. Way too much debt. Way too much debt. Well, I said to you a couple of days ago, I gave the full review, told you where it would go. I was spot on. It went up, and I said you should be trimming and taking some profits. We are up again today. Very, very wise to take profits before the next earnings. We will cover it live as we cover all the earnings live, but be very, very careful. I joined 3 days ago. Welcome. You are a guest of our show. Consider being a member to our show. Let me give you the link to the channel so you can become a member of our channel. You get many, many perks and benefits when you become a member. You get 20 times back. That's why 98% of our live viewers have a badge. They are members. I'm here to help and serve you. You can the best value membership is silver, but you can be a member from just $2 a month and you'll get back 20 times. I will make videos for you on request, reviews for you, study stocks for you, answer all your questions, reply to all your comments, support you on social media, celebrate your birthday, run polls. You name it, you get many, many perks, and it will never go up in price. No inflation here ever, and I'm here to help everybody. That's what it's all about. I had previously asked for Diageo review with the ticker DEO, but I believe the real ticker is DGE. For analysis purposes, sorry about that. Gulen, let me go and check the list. Let me go and check the review list. We're doing 2 reviews this morning. Let me have a look. Now, yes, DEO. The real ticker is DGE. Thank you very much. Yes, you did say DEO. That's fine. So it's DGE. Thank you very much indeed, Guilherme. I appreciate that very much. That might have caused a bit of chaos when I got to it. Thank you. Bill says hello. Buenos dias to all the Martin army. Ricardo Vasquez, good morning to you. Welcome to you. What's your native language? I'll speak to you in your language. Aha, I love you, man. Love you, man. I follow a Dutch guy in Holland for 3 years. I always get bored, but you keep me focused and excited. Good. That's the idea. It's supposed to make investing simple. Everybody has a voice. We have fun every Friday night in the music show. We aim to be honest. I am impartial. I'm fully invested, but on the S&P. So I've got all my money here. People have seen my channel grow from $5,000 to $66,000 live on the show. And I never short stocks. And, so it's always positive energy here. And it seems to work. And we've only been going 2.5 years, and we're growing, we're doubling our rate of growth every month, and 98% of our live viewers are members, higher than any other channel on YouTube. Right. Okay, as long as you're happy, that's the main thing. Absolutely right. Afternoon all, says David Warnes 15 minutes ago before the earnings. Okay, now then, it looks like we can set things up now. They are allowing me to log into the earnings for the first time. So here we go. Right, what do we have here this morning? Let me just prepare. Okay, there we go. Now then, we've got a new... We might have a slideshow today. You never know until the earnings starts. So let me bring you back down on this screen here while I load up the NextEra Energy earnings. Okay. Yep. It does look like we might have a... as a slideshow this morning. Okay, always nice. This is what we're showing at the moment. We shall see how that turns out shortly. It might just be an audio. You never know. But anyway, my portfolio is up. The aim is to make $300 every day. If I clear the timer just for a moment, I can share with you my position. Here we are. This is my real position. Consistently making money. It's what it's all about. Trying to make $300 a day. That's the idea. As you can see, I'm up and up and up, which is great. You can see now I'm up to $66,288. We started with $5,000, and that's where we are today. Looking very nice indeed. And I've got $99,000 in my buying power, so I can drop just about 100 grand on whatever I choose whenever I'm ready. And I'm earning about 70 cents a day, something like that at the moment on my uninvested cash. So that's not bad. We're earning money left, right, and center, which is what it's all about. Consistently make money, not follow the trends, just consistently make money. And I've calculated if you take away the times, if you focus on not losing money, and you'll make more money. If you're always trying to chase stocks, trying to make money, you will overall lose money. Some days you'll be great, some days you'll be better than others, some days you'll lose, some days you'll win, but overall you probably won't do very well. Remember, 95% of day traders lose money. If you concentrate on not losing money, just because you can trade doesn't mean you should trade. And if you focus on buying value, doing the research like we do here every day, we've got 2 reviews coming up, and you don't lose money, when you do make money, the money you make is far more valuable because you've not lost the last few months or whatever. It's like going into a casino and someone celebrates their wins, but they forget to tell you how many times they've lost. I like to consider myself as the man who owns the casino but doesn't play in the casino. That's the way I've looked at it. I thought about that last couple of days, and I like that analogy. I made that up a couple of days ago. It sounds quite good, right? Own the casino, don't play the casino. That's it. So there you go. There's my position. We're making money today, which is very, very nice indeed. We're seeing Virgin Galactic earlier go back down. Let's go and have a look at it again. Let's see where it is now. Let's see if it's moving. It did dip. It's back up again now, above $2. We had a bit of a dip earlier, but anyway, we're not here for that right now. We're focusing on NextEra Energy. We've got just 11 minutes to go before the earnings. We're all poised and ready. Is Tesla recovering? Tesla is still going down. 189 this morning, 189. So we are still losing on Tesla. So imagine where the S&P will be when Tesla returns, because it's 1.7% of the S&P. Remember that. It's 1.7. It's in the top 7 stocks, and it's down, and the S&P is rising. So now it may be a good time to buy the S&P. However, we've got more earnings to do. Often goes up before the earnings, so we need to be careful if we're suddenly going to jump in buying the S&P. I'm going to do it. I've got 100 grand to do it. However, I'm not ready to do it yet because we've got Google coming up, Microsoft coming up, Amazon and Apple all coming up next week. And we've also got, on the same day as Google, we have got the Fed report. So there will be volatility. So it's great that it's going up, and I'm 99% in anyway. But the money I've got on the side, the $100,000, there it will remain earning 5%, 5.25% until we get to the Fed report. Now, I will cover that live. And, we'll see how that goes. But I'll also cover Google, Microsoft, Amazon, Apple, and all the other earnings as well. So we're here ready to buy. It's great. It's going up. But we're at all-time highs now, so we don't want to be just chasing the asset all the time. All right. In fact, we never chase the asset, do we? All right. But it's good. It's setting new all-time highs, because what that means is if and when we will get a trim off, we will. When we do, it's likely to bounce back to those levels and exceed it. So that's great. So you win both ways. You win because it's going up anyway. And you know, when we get the earnings, when we get the Fed report, we'll be able to trim it. Sorry, not trim it. I'm not selling any of it at the moment. And then buy some more, or just add to the pot. Anyway, let's have a look here this morning and see how many people have we got watching. We've got 8 minutes to go. Let's go into, hang on a minute. Let me come into this screen down here. It's always different on earnings. Now then, we've got 85 watching. Thank you very much indeed. Shall we see if we can just get only 50% of people are signed in? So let's see if we can get 42 likes. Right, we got 7 at the moment. Are you ready? Smash the like button. Let's refresh it in 5, 4, 3, 2, 1. 7 up to 28. 28. All right. I think the best we can do is about 40, because sadly only 50% of you are signed into Google. I never understood why. But anyway, that's just the way it is. So let's do it again in 5, 4, 3, 2, 1. 28 becomes 34. Yay! We could probably get to 40. There we go, 34. Let's try one more time. We've got the earnings in 7 minutes' time. It's earnings for NextEra Energy in 5, 4, 3, 2, 1. 40. We did it. Now, the reason why I ask you to like the video is because, one, it helps the channel, but most importantly, it's benefit for you. We're not trying to grow the biggest YouTube channel in the world. We're trying to grow the best, most engaged channel in the world. That's my aim. That's what I'm working for. That's why I sit here 10 hours a day for the last 2.5, nearly 3 years now. So if you like the content, please click the like button. Great. If you don't, however, please sign into Google and down-like it. I don't mind. If you don't like me, that's fine. I might not like you. You know, a lot of people in the world don't like each other. It's perfectly okay. I don't mind. But if you click the down like button, you won't see my content anymore, and you will find what makes you happy, right? It will give you a much better life. You won't see me anymore. You can stop moaning about me every morning and find something you do. And what we're left with is the people that love the show. So the engagement rate goes up and up and up, and that's why we're growing so consistently. So that's why I ask you to like it or down like it. I don't mind what you do. I just want you to do something. What's best for you is best for me. 46, there we go. More than I deserve. Thank you very much indeed. Can't ask for better. Right, 6 minutes to go. We're looking at the earnings for NextEra Energy. There we go. Now let's read some more comments. A couple of days ago, you were explaining step-by-step numbers about plug power. It would be nice to have a couple of them in the future. It would be nice to have a couple of them in the future. Plug power. What do you mean? It would be nice. What, would be nice for you to own some plug? Yes, it's a very good company. I would be buying it on the earnings, though, not now. Bill says, become the member of the community. There you go. Should I give Kay Niazi the link to become a member? It works on all devices. If you are on an iPhone, you will need to use a browser and request the desktop version. There it is. Now then, we're looking at Alpha Spread this morning, the best, most advanced algorithmic software to study stocks. I'm not sponsored or paid to say that. It's what I use. It's why I consistently report and tell you when it's the bottom of a stock and all the rest of it. This is why I use it. My members can get a free everyone can get a free version of this, but my members can get a discount of up to 10% on a premium plan. And if you use the service, I get absolutely nothing. They don't pay me. I don't earn any money if you get the free plan. If you do get the premium plan, I get a one-off commission, which is nice. But you can use the service for free, just so you know. All right, okay. There is Alpha Spread, and we use that to study all the stocks. NextEra Energy, 3 minutes to go. Let me get through the questions. Very good news, which means Virgin Galactic is also going up. What that? Oh, about spending, you mean? Yes. Hi, Martin. My Tesla stock is down 17%. Should I keep or sell? What do you reckon? Over the next few days, it could go a lot lower. It could go as low as about 110. But it may be even, maybe even 100. The way I'm buying it is I'm buying the S&P because it's 1.7% of the S&P. So you're getting the benefit of the whole index going up at the moment. Economy's improving, rates are going to come down, and when Tesla goes up, you will benefit from owning the S&P with the assurance and the dividend. So that's how I'm doing it. But yes, if you want to buy the stock individually, and I like Tesla, but I don't own the stocks individually because I aim to be impartial, not to be seen to be pumping and dumping stocks. So I'm fully invested in the market, and Tesla is in the market. But I don't own it. So you know the information that I'm giving you is real and genuine. All right? Okay. That's why I do it that way. Martin, have you had the time to look at the plug news from Germany? I haven't, Henrik. I haven't. I'm doing the earnings now, then I'll post the earnings, then I got 2 reviews, and then I will try and do it after that. I'm so sorry. Thank you for taking the time to send it to me. I will read it, and I do read and look at everyone's information. Everyone that's a member, I do look at all your information, so I will. Good morning. We'll do that. There you go. Awesome stuff. Good morning, Jardistick. Our Easter Bunny is here this morning. Our Easter Bunny, whenever Easter Bunny shows up, good things can happen to the channel. Here is Easter Bunny. Here he is. That's Jardistick. You've seen his video. Gets very exciting when he turns up, as does Bill. We've got Santa Bill as well. When Bill turns up, good things can happen on the channel as well. All right, so anyway. Stay involved, stay engaged. Absolutely correct. Here we go. Buying and selling is of no use, and the day will come when you will have a loss. So just buy at the right time and only sell at the peak. And a high point of Virgin Galactic is 10. 10, that's where it started, and that's where it will end, says Raman. Okay. Good day, legends. Yes, send me the link. I mean, taking the steps with us, explaining how to read the numbers. Yes. I explain it. I'm live every day explaining it. Any questions, I will answer it for you. All right, I've got to go because it's now time to go into the earnings for NextEra Energy. So here we go. We're just preparing now. Let's unmute. Okay. Let me mute the audio. So we're playing audio at the moment. They typically go 1 or 2 minutes late. All earnings do. This is my portfolio. Again, not beating the market. We are the market. But consistently making money, which is what it's all about. As you can see, we're up today. The target is $300 a day. I've made 92 on my Roth and 184. So $300 a day is my target. That's what I'm doing consistently, which is great. $300 a day. That's $1,500 a week. That's the target. And that's what we're doing. So, very, very happy with that. Can't knock that. And I'll consistently buy the market. And then eventually I will announce I am aiming at $400 a day. But right now, $300 a day. I thought we were going to start them. Let me just mute that. Don't want to get caught out with copyright this morning. NextEra Energy coming up in just a few moments.
Good morning and welcome to the NextEra Energy Inc. and NextEra Energy Partners LP fourth quarter 2023 earnings conference call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star, then 1 on your telephone keypad. To withdraw your question, please press star then 2. Please note this event is being recorded. I would now like to turn the conference over to Kristen Rose, Director of Investor Relations. Please go ahead.
Thank you, Andrea. Good morning, everyone, and thank you for joining our fourth quarter and full year 2023 combined financial results conference call for NextEra Energy and NextEra Energy Partners. With me this morning are John Ketchum, Chairman, President, and Chief Executive Officer of NextEra Energy, Kirk Cruz, Executive Vice President and Chief Financial Officer of NextEra Energy, Rebecca Chiava, President and Chief Executive Officer of NextEra Energy Resources, and Mark Hickson, Executive Vice President of NextEra Energy, all of whom are also officers of NextEra Energy Partners, as well as Armando Pimentel, President and Chief Executive Officer of Florida Power and Light Company. John will provide some opening remarks and will then turn the call over to Kirk for a review of our fourth quarter and full year results. Our executive team will then be available to answer your questions. We will be making forward-looking statements during this call based on current expectations and assumptions, which are subject to risks and uncertainties. Actual results could differ materially from our forward-looking statements if any of our key assumptions are incorrect or because of other factors discussed in today's earnings news release, in the comments made during this conference call, and the risk factors section of the accompanying presentation, or in our latest reports and filings with the Securities and Exchange Commission, each of which can be found on our websites, www.nexteraenergy.com and www.nexteraenergypartners.com. We do not undertake any duty to update any forward-looking statements. Today's presentation also includes references to non-GAAP financial measures. You should refer to the information contained in the slides accompanying today's presentation for definitional information and reconciliations of historical non-GAAP measures to the closest GAAP financial measure. With that, I will turn the call over to John.
Thanks, Kristen, and good morning. NextEra Energy had strong operational and financial performance at both FPL and Energy Resources in 2023. NextEra Energy delivered full-year adjusted earnings per share of $3.17, up over 9% from 2022, exceeding the high end of our adjusted EPS expectations range. From solar supply chain challenges to higher inflation and interest rates, NextEra Energy navigated through a challenging environment the last 2 years, delivering compound annual adjusted EPS growth of roughly 11.5% since 2021. These were unprecedented events for our sector and clear headwinds for renewables, but disruption often presents opportunity. At NextEra Energy, we relied on our 25 years of renewables experience and our culture of execution to navigate this tough environment. On the strengths of our scale and competitive advantages, our world-class supply chain capabilities, customer relationships, access to and cost of capital advantages, the strength of our balance sheet, our data-driven development playbook, and our team, just to name a few, we successfully managed through the disruption. Our scale and competitive advantages served as key differentiators and allowed us to continue to deliver for our customers and extend our long track record of earnings and dividend growth. Over the past 10 years, we have delivered compound annual growth and adjusted EPS of roughly 10%, which is the highest among all top 10 power companies. Over that same period, the remaining top 10 power companies have achieved, on average, compound annual growth and adjusted EPS of roughly 2%. Notwithstanding the strong adjusted EPS results, we recognize and are disappointed by the underperformance in the share price. And as we start 2024, we remain steadfast in our continued focus on execution and creating long-term value for shareholders. We believe the disruption over the last 2 years has made NextEra Energy an even stronger company. Our business model is more resilient, our development platform is even more advanced, and our supply chain is more diversified than it has ever been. Bottom line, we believe NextEra Energy is well positioned headed into 2024. And there is good reason for optimism at NextEra Energy. Although nobody can predict with certainty what 2024 will bring, inflation and interest rates have declined from their peak, and NextEra Energy has taken steps to mitigate its exposure to interest rate volatility through its interest rate hedging program. The Commerce Department has provided the final determination around circumvention, providing solar suppliers with more certainty around the rules and expectations of importing solar equipment. New solar supply chains have been established in the U.S. and internationally, leading to lower solar panel prices. Longer-term push towards EVs as being incrementally positive for continued reductions in battery prices. Solar panel and battery prices have already declined by roughly 25% from their peak over the last 24 months, heading into 2024. We have proactively procured critical electrical equipment to complete our renewable projects, securing enough transformers and breakers to cover our expected partnerships. We have not experienced any labor shortages impacting project timelines. Ultimately, all these tailwinds are great for customers and we believe should drive greater renewables demand in 2024 and beyond, all on the heels of consecutive record years for new renewables originations at Energy Resources in 2022 and 2023, totaling over 17 gigawatts. NextEra Energy offers a unique value proposition with two strong businesses that we believe are strategically positioned with outstanding prospects for future growth. FPL, which represents more than two-thirds of our company, is the nation's largest electric utility and continues to deliver what we believe is the best customer value proposition in one of the fastest growing states in the U.S. Energy Resources, the world's renewables leader, has differentiated itself in an industry in which scale, experience, and being well capitalized matters. At NextEra Energy, the plan is simple. Our two businesses are deploying capital in renewables and transmission for the benefit of customers, providing visible growth opportunities for shareholders. At FPL, we identify investment opportunities that drive value for customers and support Florida's growing economy while keeping bills approximately 30% lower than the national average. We focus on running the business efficiently and continue to lead the industry with the lowest non-fuel O&M per megawatt hour of any large utility in the nation. Our emphasis on modernizing FPL's generation fleet to improve efficiency and reduce fuel costs has saved customers over $15 billion since 2001. We continue this trend in 2023 by placing into service approximately 1,200 megawatts of cost-effective solar and expect to add roughly 4,800 megawatts over the current rate agreement. And by 2032, we expect to increase FPL solar from 5% of our total generation today to roughly 35% by adding over 15,000 incremental megawatts. We are also continuing to invest in FPL's grid to make it stronger and more resilient for our customers. Almost all of FPL's transmission system has been hardened with concrete or steel towers or poles, and we continue to invest in undergrounding our distribution system to further enhance reliability and resiliency for customers. The capital plan of the current rate agreement of $32 to $34 billion extends our customer value proposition and provides clear visibility for growth through 2025. Beyond 2025, we continue to believe FPL is strategically well-positioned as Florida remains one of the fastest-growing states in the U.S. with a population growth that is expected to roughly double the national average through 2030. Florida's economy is also growing and is now the 14th largest in the world if Florida were a country. FPL is responsible for keeping the lights on for approximately $2 billion per day of Florida's GDP. These long-term growth prospects, coupled with investment opportunities in renewables and transmission and distribution infrastructure, enhance our best-in-class customer value proposition and support our belief that FPL is the highest quality rate-regulated utility in the country. Energy Resources' deep expertise in renewables and transmission serves as a key differentiator with customers. As a result of our data-driven development playbook, Energy Resources had a record year of new renewables and storage origination, adding approximately 9,000 megawatts to our backlog. Driven in part by the roughly 5,600 megawatts placed in service in 2023, Energy Resources grew adjusted earnings almost 13% versus 2022. Energy Resources continues to see strong demand and is well positioned to realize its development expectations over the 4-year period ending 2026. Assuming we achieve the midpoint of the range, Energy Resources will be operating a roughly 63 gigawatt renewable portfolio by the end of 2026 that would be larger than the installed renewables capacity of all but 9 countries. Energy Resources also is extending its excellent track record of optimizing our existing footprint to create additional shareholder value. To date, we have repowered 6 gigawatts of our existing 24-gigawatt wind operating fleet, investing roughly 50 to 80% of the cost of a new build and starting a new 10 years of production tax credits, resulting in attractive returns for shareholders. By 2026, Energy Resources' wind footprint could be roughly 32 gigawatts, and with over a decade to potentially qualify for repowering, it represents a great opportunity set. We believe there are multiple opportunities to drive value from the existing footprint, multiple wind repowers, adding solar underneath existing wind, and co-locating battery storage with existing wind and solar. And we have dedicated teams leveraging our development playbook to optimize our existing and future fleet. We can maximize existing land, permits, interconnection capacity, and operations to provide enhanced value to customers and shareholders. By 2026, Energy Resources could operate up to 53 gigawatts of generation with the potential to co-locate battery storage, which represents a great long-term opportunity, especially considering the likely future capacity needs of customers. Throughout 2023, Energy Resources also continued to build what we believe is the nation's leading competitive transmission business. As growth in renewables occurs throughout the U.S., there is a growing imperative to build additional or upgrade existing transmission. 2023 was a record year for our competitive transmission business. NextEra Energy Transmission was awarded projects to construct transmission in PJM, CAISO, and SPP that would roughly double the investments made in the existing business. We anticipate deploying approximately $1.9 billion of capital through 2027 to complete these transmission projects, which we estimate could enable up to 12 gigawatts of new renewables. Beyond 2026, Energy Resources is strategically positioned to benefit significantly from the irreversible shift towards electrification. With renewables only comprising roughly 16% of the U.S. generating mix, Energy Resources is just getting started. Renewable penetration is expected to double to over 30% by 2030, and Energy Resources is ready. We have a substantial development pipeline, including roughly 150 gigawatts of interconnection queue positions for new renewables and storage projects. We believe Energy Resources has the most comprehensive renewable energy business in the world and is better positioned than ever to capitalize on long-term growth prospects. FPL and Energy Resources individually have executed well, delivering value for our customers. Both businesses complement each other, push one another to be better, and together create scale and foster innovation. We have one of the sector's strongest balance sheets and constructed and placed into service roughly 6,800 megawatts of new renewables and storage projects in 2023. To put that into context, 6,800 megawatts of installed U.S. renewable generating capacity is enough on its own to rank as the fourth largest U.S. renewable energy company and the 14th largest utility. Turning to NextEra Energy Partners, we continue to focus on executing against the partnership's transition plans and delivering an LP distribution growth target of 6% through at least 2026. Last September, we made the tough decision to reduce the target distribution growth rate to 6% when NextEra Energy Partners no longer benefited from a competitive cost of capital. With a growth rate now comparable to its peers, we are focused on the partnership's cost of capital improving, which is critical for its future success. Towards that end, we are evaluating alternatives to address the remaining convertible equity portfolio financings with equity buyout obligations in 2027 and beyond. We are executing against the transition plans, and with the closing of the Texas pipeline portfolio sale, the partnership has addressed 2 of the 3 near-term convertible equity portfolio financings. The STX midstream convertible equity portfolio financing has been extinguished, and we have sufficient proceeds available to complete the NEP Renewables 2 buyouts that are due in June 2024 and 2025. The third convertible equity portfolio financing associated with the Meade natural gas pipeline assets is expected to be addressed in 2025. Looking ahead to 2024 and beyond, NextEra Energy Partners does not expect to need an acquisition in 2024 to meet the 6% growth in LP distributions per unit target, and the partnership does not expect to require growth equity until 2027. We are executing against the growth plans and have identified approximately 985 megawatts of wind repowers through 2026, making progress against our expectations. As we turn the page on 2023 and head into 2024, we are optimistic about the renewable sector, about our opportunity set, about customer demand, and about NextEra Energy's future. Demand for renewables has never been stronger, and yet the challenges have never been more complex, making the stakes even higher for customers. Our scale and competitive advantages are enabling us to be the partner of choice with both power and commercial and industrial customers. On March 14th, we will discuss Energy Resources development process in greater detail at our development investor event in Juno Beach and illustrate how our proprietary tools differentiate Energy Resources with customers. And then on June 11th, we will hold our NextEra Energy Investor Day in New York to discuss our long-term plans for both Energy Resources and FPL. Our optimism for NextEra Energy's future flows from the strength of our 2 world-class businesses, FPL and Energy Resources, that leverage our scale and competitive advantages to differentiate themselves as leaders. Our optimism is driven from our proven playbooks of deploying capital in renewables and transmission to create value for customers. But I am most optimistic because we have spent the last 2 decades building a world-class team at NextEra Energy, and it is, by far, our greatest competitive strength. Our team lives and breathes a culture of continuous improvement, working together to solve the tough challenges of the day. We drive innovation relying on data analytics and automation to make better decisions, and we have developed and deployed smart, low-cost, clean energy solutions that lead our industry. Most importantly, our team remains hyper-focused on continuing our long track record of execution, serving our customers with excellence, and providing long-term value for shareholders. With that, let me turn it over to Kirk, who will review the 2023 results in more detail.
Thanks, Sean. Let's begin with FPL's detailed results. For the full year 2023, FPL's adjusted earnings per share increased 22 cents versus 2022. FPL's adjusted earnings results exclude the approximately $300 million after-tax gain on the sale of Florida City Gas, which closed on November 30th, 2023. The principal driver of the 2023 full-year performance was FPL's regulatory capital employed growth of approximately 12.5%. We continue to expect FPL's average annual growth in regulatory capital employed to be roughly 9% over the 4-year term of our current rate agreement, which runs through 2025. For the full year 2023, FPL's reported ROE for regulatory purposes will be approximately 11.8%. During the full year 2023, we used approximately $227 million of reserve amortization, leaving FPL with a year-end 2023 balance of roughly $1.2 billion. FPL's capital expenditures were approximately $2 billion in the fourth quarter, bringing its full-year capital investments to a total of roughly $9.4 billion. These capital investments supported the successful commissioning of roughly 1,200 megawatts of solar in 2023, continued hardening of the grid, and our efforts to underground our distribution system. During the fourth quarter of 2023, our 25-megawatt hydrogen pilot at the Okeechobee Clean Energy Center successfully achieved commercial operations. As a reminder, we plan to utilize this facility together with adjacent solar projects to create green hydrogen and blend it with natural gas at our Okeechobee plant. Key indicators show that the Florida economy remains strong and Florida's population continues to be one of the fastest growing in the country. Florida's economy continues to trend upward, and its GDP is now roughly $1.6 trillion, an increase of 9.3% over last year. For the fourth quarter of 2023, FPL's retail sales increased 1.6% from the prior year on a weather-normalized basis, driven primarily by continued strong customer growth, which increased by nearly 81,000 from the prior year comparable quarter. For the full year 2023, FPL retail sales increased 0.6% from the prior year on a weather-normalized basis, also driven primarily by the strong customer growth in our service territory. Now, let's turn to Energy Resources, which reported full-year adjusted earnings growth of approximately 12.9% year over year. Contributions from new investments increased by 35 cents per share due to strong growth in our renewables and storage portfolio. Contributions from our existing clean energy assets decreased results by 11 cents per share, driven primarily by the impact of weaker wind resource. 2023 was the lowest wind resource on record over the past 30 years. Our customer supply and trading business increased results by 16 cents per share, primarily due to higher margins in our customer-facing businesses. Other decreased results by 26 cents per share year over year. This decline reflects higher interest costs of 22 cents per share, of which 10 cents was driven by new borrowing costs to support new investments. Energy Resources delivered our best year ever for origination, adding approximately 9,000 megawatts of new renewables and battery storage projects to our backlog, which includes approximately 2,060 megawatts since our last call. Our 2023 origination performance reflects continued strong demand from power customers looking for the least cost alternative to serve load and to replace uneconomic generation, and commercial and industrial customers looking to help decarbonize their operation or meet their data center and AI demand. Our renewables backlog now stands at more than 20 gigawatts after taking into account roughly 2,470 megawatts of new projects placed into service since our third quarter call. We believe our 20 gigawatt backlog provides clear visibility into Energy Resources' ability to deliver for shareholders through 2026 and beyond. Turning now to the consolidated results for NextEra Energy. For the full year, adjusted earnings from our corporate and other segment decreased by 8 cents per share year over year, primarily driven by higher interest costs. We successfully supported the growth in our underlying businesses from our strong operating cash flows, including the sale of tax credits, as well as our historical funding sources. In 2023, we grew cash flow from operations well in excess of our adjusted earnings. We transferred approximately $400 million of tax credits, establishing relationships with numerous counterparties. We believe this will prove to be a competitive advantage as buyers look first to NextEra Energy, given its size, experience, and the overall quality of its tax credit program. Overall, our funding plans for 2024 through 2026 remain consistent with the information we shared on the third quarter earnings call. We continue to believe NextEra Energy is well positioned to manage the interest rate environment. While the recent decline in interest rates is encouraging, we remain committed to managing the business to deliver value for customers and shareholders. Overall, we believe we are well positioned with $18.5 billion of interest rate swaps, and we will continue to closely monitor the interest rate environment as declines in rates certainly represent a tailwind for our sector and customers. Our long-term financial expectations remain unchanged. We will be disappointed if we are not able to deliver financial results at or near the top end of our adjusted EPS expectation ranges in 2024, 2025, and 2026. For the last 14 consecutive years, NextEra Energy has met or exceeded its financial expectation, which is a record we are proud of. From 2021 to 2026, we continue to expect that our average annual growth in operating cash flow will be at or above our adjusted EPS compound annual growth rate range. And we also continue to expect to grow our dividends per share at roughly 10% per year through at least 2024 off a 2022 base. As always, our expectations assume our caveats. Now let's turn to NextEra Energy Partners. In terms of the transition plans, NextEra Energy Partners closed the sale of the Texas pipeline portfolio in late December, providing net proceeds of approximately $1.4 billion. NextEra Energy Partners expects to complete the NEP Renewables II buyouts of roughly $190 million and $950 million on their stated minimum buyout dates of June 2024 and 2025, respectively, as the partnerships continue to benefit from the low cash coupon through 2025. In terms of NextEra Energy Partners' growth plan, as a reminder, it involves organic growth, specifically repowerings of approximately 1.3 gigawatts of wind projects through 2026, as well as acquiring assets at attractive yields. Today, we are announcing plans to repower an additional approximately 245 megawatts of wind facilities through 2026. The partnership has now announced roughly 985 megawatts of repowers with strong cash available for distribution yields. While the partnership does not expect to need an acquisition in 2024, the LP distribution growth target of 6% is supported in part with roughly 175 megawatts of wind repowers, which are expected to generate attractive cash available for distribution yields. Finally, we were pleased with the high-yield note issuance of $750 million, which was completed during the fourth quarter of 2023. This opportunistic refinancing allowed the partnership to pay off its corporate revolver in mid-December. Let me now turn to the financial results for NextEra Energy Partners. Fourth quarter adjusted EBITDA was $454 million, and cash available for distribution was $86 million. Adjusted EBITDA growth versus the prior year comparable quarter was primarily due to new asset additions and the incentive distributions right fee suspension, while cash available for distribution was also impacted by incremental debt service. For the full year 2023, adjusted EBITDA was approximately $1.9 billion, up 13.6% year over year, and was primarily driven by the contribution from new projects acquired in late 2022 and during 2023, and the incentive distribution right fee suspension. New investments added approximately $228 million, and the incentive distribution right fee suspension added approximately $113 million of adjusted EBITDA year over year. This growth was partially offset by a decline from existing projects driven primarily by weaker wind resource. Cash available for distribution was $689 million for the full year, and primarily driven by contributions from new projects of approximately $42 million and the incentive distribution right fee suspension of $113 million, while being partially offset by the weaker wind resource. Yesterday, the NextEra Energy Partners Board declared a quarterly distribution of 88 cents per common unit, or $3.52 per unit on an annualized basis, which reflects an annualized increase of 6% from its third quarter 2023 distribution per unit. The partnership grew its LP distributions per unit by more than 8% year over year. From an updated base of our fourth quarter 2023 distribution per common unit and an annualized rate of $3.52, we continue to see 5 to 8% growth per year in LP distributions per unit, with a current target of 6% growth per year as being a reasonable range of expectations through at least 2026. We continue to expect the partnership's payout ratio to be in the mid-90s through 2026. We expect the annualized rate of the fourth quarter 2024 distribution that is payable in February 2025 to be $3.73 per common unit. NextEra Energy Partners is introducing December 31st, 2024 run rate expectations for adjusted EBITDA in a range of $1.9 to $2.1 billion, and cash available for distribution in a range of $730 to $820 million, reflecting calendar year 2025 expectations for the forecasted portfolio at year-end 2024. As a reminder, our expectations are subject to our caveats. That concludes our prepared remarks, and with that, we will open the line for questions.
We will now begin the question and answer session. To ask a question, you may press star, then 1 on your telephone keypad. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star, then 2. At this time, we will pause momentarily to assemble the roster. And our first question will come from Shar Pourreza of Guggenheim Partners. Please go ahead.
Hey, good morning, guys.
Morning, Shar.
Good morning. Just starting on NEP, if it's okay, just on the higher repowering opportunities you announced, I guess, how are you sort of thinking about funding it? And really more importantly, is there any specific status on the money pool that could be looking to buy in directly into projects, whether it's drop downs or organic growth at the NEP level? Could these sort of equity investors help solve the 26 growth and financing issues? And I guess, when do you plan to update on that?
Sure. So with respect to repowering, Shar, we look at that as on the project level. There's really two options there. We can look at it from a project financing standpoint and pair that with transferability, or we can look at it as tax equity. So we will look at both of those options and decide that at the time of the repowerings. With respect to your second question, we're looking at all options right now, as John said in the prepared remarks. We are exploring a number of opportunities and alternatives for addressing the convertible equity portfolio financings that are coming due in 2027 and beyond. There's really not a time frame in terms of the update now, but we are looking at all options, and with the goal of really maximizing unit holder value.
Got it.
Yeah.
Got it.
And Shar, this is John, just adding on to that, again, on the repowers, just like we do at NEE, I mean, just think about it as tax equity and project finance.
Got it.
And
Okay.
and again, the private capital raises provide us with a number of options, but we're looking at a lot of different alternatives, that being one of them.
Okay, perfect. And then lastly, John, we haven't had any updates from the FEC. Has anything sort of been communicated to you regarding sort of the investigation, how quickly you would look to settle, assuming they take up the case? And as we're kind of thinking about the process, right, it's confidential. So curious on how you're going to update investors. Like, would we see a press release or an 8K from you confirming the FEC process and that you'll update investors in the future on next steps? Or could we see a single communication on the FEC pickup and a concurrent settlement, let's say? I'm just trying to assess how long this could be an overhang, assuming the case moves forward, and whether you've already laid the groundwork for all options to get this kind of past us quick when a ruling comes out. Thank you.
Yeah, thanks for the question, Shar. So let me just take those in order. First of all, there's no update. We have not been contacted by the FEC, and I think just to remind investors of the timing, first of all, these are just guidelines I'm going to give you. I mean, there is no prescribed timeline in terms of the FEC providing a response to us. But as you may recall, we originally received the FEC complaint, I guess is what you would call it, that had been filed by a group called CREW back in November of 2022. And if you follow the historical precedent of the FEC, it's usually 12 to 18 months after you first are notified of a complaint having been filed that you would learn whether or not the FEC decides to find that there's reason to believe that they ought to conduct an investigation. We have not heard anything, from the FEC in that regard. The second thing I would remind investors of is, this is not material. Again, these were 5 allegations, totaling political contributions of roughly 1.3 to $1.5 million. So we're talking about smaller dollar amounts, and how and when we would update investors would depend on what exactly we hear from the FEC.
Perfect. Thank you very much. Appreciate it, guys. See you soon, and congrats on the results. Appreciate it.
Thank you, Shar.
Thanks, Shar.
The next question comes from Steve Fleischman of Wolfe Research. Please go ahead.
Yeah, hi, good morning, thanks. I guess a couple big picture questions. First, obviously a lot more focus in the elections now as we're in 24, and curious your thoughts in the event of a Republican trifecta, so to speak, just how you're thinking about the sustainability of IRA provisions.
Sure, Steve. Let me go ahead and take that. This is John. First of all, in the 21 years I've been at the company, as we've changed administrations and we've seen changes in Congress, we've never seen a change or a repeal of tax credits, no matter what form they've taken. IRA is the form we're talking about here. So that's the first point I would make. Second, it's really hard to overturn existing law. I think Obamacare is a very good example of that. It's just very difficult, no matter what the political winds are. The third point I would make is that the IRA benefits both sides of the aisle. It certainly is advantageous for obvious reasons for Democrats, but it also has a big benefit to Republicans, because if you think about where the investments are being made around IRA and where a lot of the benefit of IRA is flowing, it's flowing to Republican states, and it's flowing to parts of those states that are really difficult to stimulate economically, and we're talking about rural communities in these states. And so when we come in and we build a wind project, we build a solar project, we build a battery storage project, it's a complete turnaround for these communities. We're providing an economic base in the form of jobs. We're providing an economic base in the form of spending that occurs in that community. We're providing an economic base in the form of property taxes and sales tax revenues. These are 180s, for these rural communities and make a huge difference on their viability going forward. Just think about hospitals and staffing doctors at county hospitals, or paying teacher salaries. I mean, the property tax revenues have significant benefits. And so for those reasons, we've always been able to work with both sides of the aisle. So see any repeal of IRA as being unlikely.
Okay. And I guess two other big picture questions on the renewables business. Just any kind of new thoughts, color on your data center strategy, and also your thoughts on hydrogen after based on the proposed rules that came out?
Good morning, Steve. It's Rebecca. First on the data centers, clearly there's an enormous amount of demand being driven across the U.S. economy by the growth in data centers, driven by a lot of things, of course, but specifically generative AI, and that growth is pretty explosive at this point. And I think the characteristics of that demand are a little bit unique, and driving different ways in approaching the marketplace for a number of these technology companies, where it is imperative that these projects get built on time, on budget, and produce the energy that they're expecting, because the opportunity cost for these customers is so significant if they aren't able to power them and, of course, meet the commitments that they've made to their own stakeholders. So we're seeing those relationships expand and also deepen, where it's not just signing the megawatts of the day, but also working with them collaboratively over a long period of time to ensure that they get the energy and capacity that they need where they need it to support their projects. Just alone in our backlog, not even counting what we have installed, we have over 3 gigawatts of projects that we're building in the coming years for these customers. And I do believe that's the tip of the iceberg. And again, not even talking about what we already have installed. So it's pretty exciting, and our team is very ingrained in working with these customers, and we're really excited about the years ahead. And then turning to hydrogen, obviously the guidance that first came out, the draft guidance in December, is really steering towards hydrogen projects that will be essentially from day one needing to match on an hourly basis. And that, of course, increases the ultimate cost of hydrogen. And unfortunately, I think if it stands as currently drafted, would limit to an extent how much will be built for the U.S. market. We're obviously advocating for more of a relaxed matching requirement, so more of an annual match for a period of time and then transitioning to hourly over time so that you can kickstart a hydrogen market. And hopefully the administration will hear that and know that having a kick-started hydrogen economy will certainly further their ambitious goals, which, of course, we are very excited about meeting to see the full decarbonization of the U.S. economy over time. So more work to be done, and we're excited to pursue the marketplace. Regardless, these are probably end-of-the-decade type projects, so more of an investment in the near term for opportunities in the long term.
Okay, great. Thank you very much.
Thanks, Steve.
The next question comes from David Arcaro of Morgan Stanley. Please go ahead.
Hey, good morning. Thanks so much for taking my question.
Morning, Dave.
Maybe on the renewables demand side of things, could you give a little bit more detail on the origination trends that you're seeing? I guess it looked like solar and storage quite strong in the quarter, but then wind a little bit lower in terms of the new bookings added. Maybe what's your latest confidence in achieving those 25 and 26 targets, particularly on the wind side of the business?
Hey, Dave, it's Rebecca. I'll take a first cut at that. We're obviously excited about the origination, as John and Kirk have highlighted, originating 17 gigawatts over the last 2 years, and both years serving as a record. So this year topping last year's record is very exciting. We also, of course, see the mix being more focused towards solar and storage. And as I've commented in the past, I think some of this is an after effect of the strong demand that we saw going into 2020 when we and others thought that the production tax credit would ultimately phase down and then ultimately go to zero over a period of time. So there was a pull forward of demand. And then the second dynamic that I think has impacted the short term is that the solar production tax credit clearly stimulated near-term demand and deployments for our customers, and obviously we're very excited about that. Storage is growing at least as well as we thought, perhaps exceeding even our expectations in terms of adoption, not just in the Western markets, but now really spreading in a very constructive way through the Midwest. And we've got, as John highlighted in the prepared remarks, a really advantaged position to be able to respond quickly to the demand characteristics that we're seeing, where our customers need capacity quickly, where they hadn't anticipated the demand that they would see in their underlying business. And so getting to market quickly is very much a premium and a priority, and we're there to serve them well. And that storage market, as we've talked about from a returns characteristic standpoint, is an awful lot like wind. And is certainly complex to deliver the value that our customers are looking for in the various streams. I'd say the other part that is at least as strong as we anticipated when we laid out the expectations is repowering. And we're excited about the economics of that, and economics specifically in context to the value that it brings to our customers, bringing some incremental generation and extending the life of these projects, often extending the contracts with our customers at the same times that we do repowering. So overall, with all those comments in context, I feel really good about meeting our development expectations in aggregate. We'll continue to look at the mix in individual technologies over time. But at this point, we're obviously leaving the ranges as we've had them now for a couple of years, in part to reflect what I'm sure you recall, wind is a very short development cycle, maybe not the actual laying the groundwork to be able to build a project, but when we enter into a contract and acquire the turbines and put it into service can be as short as 9 months. So there's still a lot of time left between now and the end of 26 to add more wind to not only the backlog, but ultimately commission. And when I look at the forward couple of quarters, there are a couple of chunky opportunities that our teams are working on, and I feel good about bringing them some of those to fruition.
Excellent. Thanks for that. Very helpful.
Thanks, Nick.
And then maybe secondarily, just it sounds like the backdrop has gotten more challenging for small developers in the renewable space. Wondering if you're seeing opportunities for market share gain as a result, and potentially any development pipelines to pick up from developers that might be struggling right now.
Sure. We always are out in the development rights acquisition market. In the recent couple of years, we've really prioritized our greenfield portfolio, in part because of our ability to work so closely with our customers and make sure that we're building the projects over the long term where they need them. But we will always be opportunistic in the development project market to be selective and create opportunities where it may be particularly attractive. The dynamic from a couple of years ago, where a number of the development portfolios were acquired by folks looking to, I would say compete with us, but certainly have a bigger presence on the development side. We haven't seen, those holistically come back to market. I think that may change over time. I know the private equity cycle of wanting to be able to turn over capital quickly and realize isn't necessarily completely aligned with the development cycle, where sometimes things are a little bit faster, a little bit slower than you anticipated, and you need to be patient. So I'm optimistic there'll be opportunities. But most importantly, and this is one of the things that we'll focus on in March, is we want to keep our fate, our development opportunities in our own hands. And I am super excited about what our team is working on from a greenfield development standpoint and the competitive advantages that we're investing in to make sure that we can serve our customers well, not just in the next 2 or 3 years, as we often talk about with you all, but the next 5, 7, 10 years plus down the road.
Okay, great. Thanks so much for all the color.
The next question comes from Carly Davenport of Goldman Sachs. Please go ahead.
Hey, good morning. Thanks so much for taking the questions. Wanted to just ask about transmission. You highlighted the $1.9 billion of capital through 27 at NEE, and as we look at the EBITDA contributions at NEER for 2024, that piece is moving higher as well. So could you just talk a bit about, what sort of growth you could see at NEE over the next several years and what that EBITDA contribution could be over time?
Good morning, Carly. From the pipeline perspective, is no doubt you appreciate transmission opportunities take a couple of years to come to fruition. So we're thrilled with the awards that the team has been able to secure in the last year. On one part of it, building on investments that we already have, so expansion opportunities that are significantly enabling new renewables development headed into the California market. And then other parts of the U.S. competitive opportunities that we won through competitive processes. In terms of timing, as we highlighted in the prepared remarks, the in-service dates are out to 2027. So as we invest capital, obviously that'll start to become more of a material contribution over time. And we'll give more color as we get into the investor conference, as we typically do, to give more of a breakdown by business and what those contributions will look like over time. But the momentum is terrific, and as we've highlighted, everybody understands. Maybe not to the extent that we think it's going to happen, but in order to unlock the renewables opportunity that we and others see across the United States, transmission needs to be built, and we stand ready to be a part of the solution wherever we can be and bring cost-effective solutions to customers.
Great. Thank you for that. And then maybe just one more on the financing side for this year, just based on what you've seen so far in the markets, how are you thinking about the mix of the different avenues that you can use to monetize tax credits, whether through tax equity or transferability? How do we think about the sort of magnitude of each of those in your financing plans for 24?
Yeah, Carly, this is Kirk. The financing plan, as we shared in our prepared remarks, is consistent with the information we shared on the third quarter call. And as we approach those options, we will use the historical approaches, project finance and tax equity. But we're also very encouraged by what we're seeing with the transferability market. We are having really good progress with in those conversations. We're seeing really good demand for the NextEra Energy tax credit, and ultimately we look at all those as options, and we'll optimize between project finance and transferability and tax equity, and we'll use those within the ranges that we shared and the 24 to 26 funding plan that we provided between those between the disclosure that we provided. But we are seeing really good demand for the credits, and expect to continue to utilize transferability as an option going forward.
Great, appreciate that color.
The next question comes from Jeremy Tonet of JP Morgan. Please go ahead.
Hi, good morning.
Good morning, Jeremy.
Just wanted to build off that a little bit as what you were talking about before. How do you balance, I guess, looking forward, the wealth of growth opportunities and associated funding needs relative to dividend growth? Do you look at industry trends for dividend growth at all, and how that might change as utility CapEx increases? And just a final point there, just wondering how the E&P business competes for capital against everything else that you have in a lower gas price environment.
Sure. So, we when we look at capital allocation, and you look at we shared on the third quarter call the returns that we see within the renewable business, and as we shared then at Energy Resources within for when we see returns in the low 20s on a levered ROE basis. In solar, we see returns in the mid-teens, and then storage is also in the low 20s. And so it's great returns, and we look to get capital allocated to the renewable business. As John discussed in the prepared remarks, we are allocating capital across both businesses and renewables and transmission. And so that is the priority with the way that we allocate capital. And then in terms of the funding of that, it's the way that we've traditionally funded the business. It's tax equity, it's project finance, and then we also use the transferability provisions.
Got it. Thank you for that. And then maybe just pivoting a little bit towards the backlog. A lot of additions in the quarter, but there was a little bit that fell out, I think 350, and there was a little bit more in the post-2026 timeframe that's in the backlog. So just wondering if you could talk a bit more on kind of some of the drivers, the puts and takes within the portfolio addition composition over time.
Sure. I'll take that. In terms of the, obviously the backlog additions are quite strong, and we're thrilled about that. And for this quarter, in terms of the removal that we had, it's really project-specific items. In one part is really related to higher interconnection costs for a particular project where we need to go back and do a little bit more work. Very likely these project megawatts will come back into the backlog. They're good projects, but in the near term, we're removing them while we work through the issues. I think it's important to keep in mind that as we add something to the backlog, it's tremendous visibility, and we're really excited about moving forward with the projects based on what we know at the time. But this is still a development business, and there are things that you have to work through before you commit significant capital to a project, and occasionally some of those things that we work through are better. Sometimes they're a little bit worse, and we need to make the decisions that are ultimately right for our shareholders at the time that we need to make them. So in context of a 20-plus gigawatt portfolio, I think it's de minimis for what is kind of the normal run rate for development-type issues. And fortunately, we've worked through the issues that we had talked about over the last 2 years around anti-dumping, countervailing duties, and the significant changes in the marketplace related to the inflationary pressures and changes in the interest rates. So at this point, I think we're in kind of like normal development. Every once in a while, there's something that changes our view on a specific project, and we're going to do the right thing from a shareholder perspective and only commit capital where it makes sense.
Got it. That's helpful. Thank you for that.
Thank you.
This concludes our question and answer session. The conference has now also concluded. Thank you for attending today's presentation, and you may now disconnect.
So there we go, another earnings for NextEra Energy. Thank you very much for joining me. That ended very quickly. Didn't expect it to end quite as quickly as that. I was just giving you the link for the opening bell show, which will be live in, it says just a minute. I estimated the time, but it will take me a few minutes to transfer from this show to the next event. So this video, this live event where we are now, will take you directly to the opening bell. I'll be there as soon as possible. There's a time to transfer from one show to the other. And then we've got two reviews this morning. We are doing APLD, Applied Digital, and AMD. Two reviews this morning. So I'll see you there for the opening bell in just a few moments' time. I am looking to buy Tesla through the S&P shortly. Let me explain why I'm doing it like that. First of all, I'm not in stocks individually because to be impartial and to present the best open, honest news. That way I can never be accused of pumping and dumping stocks. And also, I can interview more people, find out more things as a non-investor. But I am fully invested in the market. All my money is in, and you can see all my money is in. I've got 100 grand here ready to buy more. So I'm fully invested, and my aim is to make $300 every day. That's kind of the average what I'm doing, consistently making money and consistently beating the market, even though I'm only in the main market, because I can buy the dip throughout the day to benefit my daily return compared to the market. So what I'm looking to do is I am very bullish on Tesla long term. As an investor, not as a trader, not as a Cathy Wood self-interest, but as a long-term investor. So Tesla is on sale. However, Tesla is not cheap. It's still expensive. And Tesla makes up 1.7% of the index. So because of that, because it makes up 1.7%, it doesn't rock the index. If everything else is going up, you can hardly notice it. That's the purpose of owning an index. However, it is, even though the index is looking up today, which it is, it's up 0.41%. That's great. You are missing some of the benefits because Tesla is down. So by buying more of the index when a major part of it, and Tesla is 1.7, that is about the seventh largest asset in the company. I think it's the sixth or seventh largest asset in the index. You are able to buy the index at a discount even if it's up, because part of it is Tesla on sale. Now, Tesla is down quite a way, but I do think it can go actually quite a lot lower yet. That doesn't mean to say it will. I don't know. Doesn't really matter to me. But what I'm expecting is on the 30th, which is just a few days away, we've got Google and Microsoft who are leading the pump on the index. We'll get volatility on earnings because it's the same day that we'll get the Fed report. And I will be reporting on the Google earnings and the Microsoft earnings and on the Fed report. And during that, there could be a 5% drop. And I don't think Tesla is going to be back at its highs by the 30th. So I'm standing by with $100,000 to buy Tesla on discount with the insurance policy, if you like, of the index, which when Tesla goes up, the index will go up with it. Obviously, it's part of it. But I'm going to wait until the 30th, which is the earnings for Google and Microsoft, plus the volatility of Jerome Powell. You always get it, no matter if it's a good return or a bad performance from Jerome Powell. You always get volatility. If he says something great and everyone loves it, they still sell it. It's that people take profits to drive the market down. So always keep cash on hand, always be ready, and you can buy Tesla, I would have thought, for another week. It might get better, more than likely will get better, and even if it gets better on the day of the 30th with the other two earnings and the Fed report, you'll get volatility anyway, because if they go down or they don't report as well, you get sell-off anyway because the overall market moves. So there you go. That's what I'm waiting to do. Now, even if I have to pay more than my original purchase, because I'm up now on the S&P by about, let me have a look what I'm actually up by. My S&P is up 2.72. There you go. I might not get it for under 2.7. Get it at an overall loss, because you're not going to. Long term, you're not going to be able to buy assets, indexes or stocks cheaper than you've ever paid in the past. It's impossible because the stocks are always going up, trending up over time. But if in a week I'm able to buy it for, say, I'm up 0.5% or I'm up 1%, that's still good, because between then and now I've been earning 5.25% on uninvested cash. Make sense? So even if I'm paying slightly more than I did originally, which you're always going to do, unless you could go in the future, grab all your money from the future, come back to today and put all the money of a lifetime in the index today, then of course, that's great. That's the ultimate way to make money. But unless anyone has a time machine, then that's not really possible, right? So we're waiting. It's all about patience. It's all about time in, not timing. And it's always about education. And it comes down to my favorite saying at the moment: own the casino, don't play the casino. There you go. So, right, that's NEE earnings. I will see you back in a few moments' time with the opening bell. I'll be back as soon as I possibly can. This video will take you directly to it. Make sure that you go and vote on today's poll on X. Are you in NEE? I'll share with you on the screen what it's looking like right now. 20 votes, 65% of you are in it. Fantastic. Which is great. Plug, I've been asked a question now. Cham, what is a good entry point? Well, I bought Plug at 225, as you all know, which was the bottom. That was the time to buy it. We did it live on the show. Since then, we've had like a 40, 50% profit. Now, you should have sold it already, because we've got the earnings around the corner and the volatility of the Fed report. Okay, it's up and down, but 40, 50% profit. Why on earth didn't you sell it? I mean, I don't know. If you're not going to sell at 50% profit, when did you ever sell a stock? That's like four years on the S&P in like the space of 2 days. So I would have sold it by now. I'd be out of it by now if I was in your position. When is it good time to buy it? Well, it's a $10 stock. However, it's so you might say, well, it's okay now, but I've shown you the valuation. Go and look at the valuation report. You can see now it's becoming expensive again for where it stands at the moment. And because we've got the earnings and everything else around the corner, I expect it to go down before it goes up. Anyway, that is my thoughts on all of that. Anyway, I will see you back. That was the NextEra Energy report this morning. Very, very good. Yeah, see you back in a few minutes' time for the opening bell. I'll be there as quickly as I can. You can go there already and be in the live chat. People are already waiting. This is the live event. You can go there now, be in the live chat, have a conversation, discuss the stocks, keep everything going and keep the energy up. And I'll be there as quickly as possible as soon as I transfer from this one to that one. See you back in a few minutes' time for the opening bell. We've got two reviews today, AMD and APLD. See you back in a few minutes' time. As always, take care of yourselves and each other.